There are definitely some emerging opportunities for brands, specifically around how do you leverage AI as the ultimate collaborator and scale out collaboration, relationships, conversations with your customers. AI is really this differentiator to take, this kind of like one-way transactional quote unquote relationship and turn it into an actual conversation.
I'm Sarah Nagel. I've spent my career leading research and product development within some of the world's largest brands.
And I'm Chad Reynolds. I'm a serial entrepreneur and founder and CEO of Vurvey.
And this is AI Powered by People.
Each episode will dive into the latest AI developments and talk to an industry leader to help you better understand and utilize AI.
We'll take you inside some of the world's most famous companies and share examples of how AI is improving innovation, consumer engagement, media, and marketing.
No matter what industry you work in, we'll help you navigate one of the biggest disruptions to organizations and people today.
Hey, Chad, how are you doing? How are you feeling?
I'm doing good. I got in really late. Delayed flight from New York, like 3 a.m., but it doesn't stop. Just keep going. Keep going. Let's do it.
So you can notice my background's a little bit different here.
Where are you?
I'm in Northwest. I'm outside of Seattle, Penn Cove, where they're famous for Penn Cove mussels. It's like part of the Puget Sound.
Those would kill me.
Yeah.
All the shellfish allergies.
All the shellfish. Well, you know what? It's not just going to kill you. There was like some weird mussel thing happening in Oregon where people actually did die. So I don't.
What?
Yes, it was like some sort of.
This took a turn.
Yeah. Yeah, it was south of here. It's not up this way, but it was south of here. And I was reading about it coming out here. I don't eat fish anyway, but I was like telling my husband, I'm like, I don't know, maybe we should like hold back on the mussels. But
yeah.
Anyways, so
quite the backdrops.
Quite the backdrop. Sure. All right. So today we're going to be sharing an interview with JP Milciunas, who is from Venture Capital. So he's a VC that we're going to talk to. He's an investor, advisor, and managing director of Baselayer Ventures. But what I really want to talk about before we get to the interview with JP is you had a really big week. You got in really early, but you got in really early from New York from a Brand Innovators event. And I'd love to hear more about it.
Yeah. So Brand Innovators is an organization that pulls together primarily marketers to really understand technology, trends, insights. And so we had a 3-day summit around AI, which was a collab between Shelley Palmer and Brand Innovators. So about, 250, 300 different CMOs and leaders to talk about AI specifically. So it was being held at Paramount in the middle of Times Square.
Can you remind us about Shelley Palmer?
Oh, yeah. Shelley Palmer, CEO of Palmer Group, is one of the, I'd say, like leading consultants around technology, and over the last couple of years is definitely tried to, definitely emerged as a leading consultant to guide and advise a lot of, Fortune 100 companies around their AI strategy and then how to implement technology. Yeah, so it was great to be a part of it, and we had a session on day 3, where Shelley and I talked about just some of the different insights that we're seeing of how companies are utilizing AI, and specifically how Vurvey fits into that, which is fundamentally giving people a voice in AI as opposed to other companies just kind of scraping your image and likeness. What we're doing is actually focusing it around you, and you can share all different types of insights and ideas and express yourself, and then allowing companies to essentially plug into that as opposed and monetize it as opposed to it just being taken from you. So we had a really interesting discussion.
Coming away from it, what are you kind of most energized by?
I think there's some very clear use cases internally, that we're a part of how to use AI agents, essentially to bring a consumer segment to life. So you can actually have conversations with people even though they're not there. So there's a lot of different use cases from that to also product concept visualizations and generations that, again, are all internal, kind of the front of the innovation pipeline, which, you and I are really deep in right now. So I think everybody is fairly well aware that those use cases are being adopted, the ROI on those. But there are definitely some emerging opportunities for brands, um, specifically around how do you leverage AI as the ultimate collaborator and scale out collaboration, relationships, conversations with your customers. And you and I know just from working inside of retail, retail brands and CPGs that usually those types of relationships are not necessarily one to one. They're through social media or through traditional advertising. But AI is really this differentiator to take this kind of like one way transactional quote unquote relationship and turn it into an actual conversation. And we'll dive a little bit deeper into the conversation with JP, but this was just hearing real time from a lot of different brands, um, from like a Paramount, from like an entertainment side, through Colgate Palmolive or Samsung. Like how are you going to engage with your TV in a completely different way? So yeah, lots of really interesting conversations were had, and I'm very, very bullish on agents being really the value creator around AI, both from the business and from the consumer side.
So Chad, I'm here on vacation with some friends, with my family, and there's a bunch of people here. And I started talking about agents over breakfast, and
Ooh, that's some
trying to,
light conversation.
yeah, it's like who wants to talk about agents?
Yeah.
But trying to explain to them what agents are. In your words, how would you describe an agent to my kid, to my friends?
Yeah. Yeah. I mean, I think its simplest terms, it's a digital assistant. So when you create an agent, you can give it a name, a background, some context for kind of what it is, who it is. But specifically, the reason why it's important is that you can give it instructions and actions to take, so it can act on your behalf. And that's what's really unique is that traditionally when you think about AI, it's more in the deep learning, machine learning types of things where you're trying to do your compute is spent on analyzing the data, and it kind of shoots out an answer for you. Agents are a little bit more unique in that you can interact with them in lots of different ways. I think customer support agents are probably what everybody thinks of, or Siri or Alexa. And yes, those are agents. But you can also create agents that are collaborating together. And I think that's really where this becomes really special, is that you can create, like I know when our customers are using them, you can create an agent that is analyzing something, and then it takes that output and sends it to another agent that could be a focus on design, and taking what they're saying as an input and then creating a product design. And they can talk back and forth, they can have a conversation. And so that's really it's really the most powerful part of AI, is how you can use agents and multi-agent workflows to generate all different kinds of things.
Thank you. That I'll continue the conversation later with them. And Chad, Vurvey also got some press this week while you were in New York about fundraising and kind of next steps for the company.
Yeah, so we announced our closing of our most recent round, to really just to help us scale out global capabilities, because we've been asked to grow in different regions of the world, launching agents, consumer networks, etc. So we put that out into the press, and there was a few different articles that came out in like business journals that you can check out. We can link to in the show notes, so everybody can see. But it's really just a testament to the team and what we're building, and the deep partnerships we have with our customers. I think they're really excited about not only the vision and strategy that we have, but also really getting on the ground with them. Like this past week, we had a team out with customers on the ground working through a whole innovation workshop and how they can use AI agents to really rethink how innovation happens. So just really excited from the feedback there, but also putting some of the things out into the world around our fundraising and growth, and really where we're headed. So I was excited to see some of that get picked up.
Okay, now let's get to our interview with JP Milciunas, who's an investor and advisor to many growing businesses and the managing director of Baselayer Ventures. And just a little bit of a PSA, there's some terms from both the tech world and venture capital that may not be commonly known. We try to catch as many as we can, but terms like GPUs, graphic processing units, and liquidity event may slip through. So are you ready?
We're going to talk about liquidity events?
He talks about it.
Nice. Okay. Yeah, let's go.
Hey, JP, welcome to the podcast. It's good to see you.
Hi, Sarah. Nice to see you as well.
We would love to start with a bit of your background. So past experience, because currently, you're the founder of Baselayer Ventures and kind of work in the VC world, but love to hear about kind of what led you to where you are right now.
So I attended Georgia Tech, the Georgia Institute of Technology, in the late 90s. I graduated and moved to San Francisco and was part of what was the dot-com boom and subsequent bust. And so I had a lot of interesting experiences through the late 90s, 97, 98, 99, and then 2000, working with early stage startups, building companies. And I was working at a startup that was backed by Sequoia Capital, Benchmark Capital, and Kleiner Perkins. So we had kind of the three tier one VC investors as our seed Series A and Series B investors before that company went public and subsequently went bankrupt in '01. So we had a very quick run from 0 to 100 million in quarterly revenue, actually beating Amazon to that benchmark. And subsequently, when the dot-com bubble burst, so did our startup or our publicly traded company at that point. I took that experience and actually jumped in with some guys that I had met when I went to school in Atlanta that were working at Internet Security Systems and had left to start a cybersecurity company, and they needed a founding CEO and asked me if I wanted to do that. And so I took the reins then. I was 25 years old and went out and tried to raise a Series A round for a startup that had actual revenue, which is a unique thing that we didn't have in the dot-com bubble days. And so we created a cybersecurity company around application layer security, which in 2001 didn't exist. And if people understand security, cybersecurity in particular, it has to do with, it initially had to do with network level vulnerabilities. So making sure that your network was patched and resilient to outside attacks. But they didn't bother to spend time on application layer issues, which had to do with developer misconfigurations of code or sloppy assembly of middleware or default passwords being open. Long story short, we created a category of application layer security, competed with a bunch of companies that were well funded, and we ended up raising 4 rounds of funding, Series A through D, and sold the company Hewlett Packard for 8 times cash on cash to our investors. Visa was one of our main investors. We created Verified by Visa as a standard for e-commerce. And I took that experience and that exit, and we had grown that company from 0 to 300 employees, and basically moved into venture capital as an associate at a group in Atlanta called 5 Paces Ventures. And I was kind of let's call it a junior team member to senior leaders that were running Series A and Series B backed startups, really helping them navigate through the challenges of having to put together a pitch, having to sell a product, having to manage an organization. That I kind of played shortstop as I worked with the portfolio at 5 Paces Ventures to help those companies kind of right size or stabilize or actually go to market. Did that for about 5 years, and then joined Yahoo in 2008 when a former colleague of mine that I had worked with at my previous startup in San Francisco, her company got acquired there, and she asked me if I wanted to come join Yahoo and learn consumer internet. So spent 5 years at Yahoo in a variety of different roles, business development, some publisher affiliate network stuff, some incubation stuff. My last role there was a group called Strategy and Emerging Businesses. And what we'd do is we would look around and try to find unique pockets of intellectual property and then do either joint ventures with outsiders or internally incubate companies with entrepreneurs and try to launch those things. Spent the better part of 5 years doing that. It was a lot of fun. And then in 2012, I went back into the world of VC as an EIR at Accelerator Ventures. And through that function, I created 3 companies as a venture-backed founder. launched those companies. One was an AI company that was doing really sentiment analysis for public company board directors, and we had a lot of, and that was before people were even talking about AI. But we had a lot of learnings when we started to build that company, and we subsequently had to shut that company down for a variety of reasons. One, we found that CEOs don't want their board directors to have more information than they have, so it's a very hard thing to do, to sell into the boardroom. Another company I worked on created a JavaScript platform for high frequency trading for retail. So to be able to do some of the things that, as a fintech before people were calling it fintech, but try to do some of the things that hedge funds had a lot of capabilities to do. We used a JavaScript console to enable retail investors to develop workflows and automate programmatic trading strategies kind of off the shelf. That company is still operational, actually. It merged with a company called Options Alpha, and it provides these tools to the members of the Options Alpha network. And then I subsequently have spent, about 12 years at that firm, helping them raise a couple of funds, helping, again, like I said, as an EIR with the portfolio. And then right around 2019, I got involved with a group that was doing corporate venture capital consulting called Bionic. It's now part of Accenture, but it was a company that would go into large enterprise and kind of help them to identify, again, intellectual property that could be commercialized and monetized, help set up investment processes and workflows to develop, sort of entrepreneurship within the enterprise. And I was the resident venture capital expert and early stage expert on that team. We had a whole bunch of folks that did lots of different things. Ultimately, that company got acquired by Accenture. And right before that acquisition, I actually launched Baselayer. And so Baselayer I'm the general partner and the founder of Baselayer Ventures. It's a seed and Series A stage investment firm. We invest really at the earliest stages with founders that are either creating new categories of companies or are building things that we think are disruptive in legacy industries. And our investment thesis is one that we think it's pretty obvious to us, but it's one that not many people think about in the context of what we invest in. And I'll phrase it this way: we invest at the intersection of where consumers spend their energy and compute becomes ambient. So your user interface fades into the background, and instead of using a traditional mouse and keyboard or other things to command, application layer capabilities, you're accessing that information in different ways. And so what that could be a wearable device array that has an application layer on top of it that captures data and helps you optimize your peak performance. That could be a marketplace where you buy, sell, trade consumer goods outside of traditional, brick and mortar retail channels. That can be virtual goods and experiences, the bridges between digital and physical assets and how those things kind of link together or create value separately. So that's what we invest in. We invest early and we invest with conviction, and we either can be really hands-on if the founders want us to be, or it can be really hands-off if they don't want us to be involved. So that's it.
So just to unpack a couple of things you're talking about, just for some of our listeners that may not they're not as familiar with the VC landscape. So EIR is entrepreneur in residence. And also, could you quickly talk about just kind of the, seed series A, VC? Just kind of very quickly, just kind of what the differences are there.
Yeah, that's a great, good question. It used to be that a Series A round was your first priced round of financing, and at some point in the mid 2010 or so, people started to price seed rounds and started to call them Series Seed rounds. But in essence,
pre-Series A.
But they've kind of bastardized the term. I don't know if I can say that. The reality of it is, startup companies usually raise, about 3 rounds of financing, Series A, B, and C, before they get to a liquidity event. Series A is typically your formation round, whether that's, if you do it as a seed round or under a convertible note or a safe instrument that converts into that Series A, that's the traditional path. In some cases, people will try to do a priced seed round again, which is a Series Seed, which is a kind of a different thing. But usually you do a formation round on a debt instrument, then you convert that into your Series A with some equity investors that are providing that kind of first traction capital. Then you have your B round, which is basically your growth vector to get to potential exit, and then your C round is kind of a handoff to your more growth, private equity investors that are more later stage, writing bigger checks. I've always been involved at seed and Series A, so we're investing really at the what we call companies that have escape velocity from what's known widely as the valley of death, which is the time between your first angel money or friends and family money and the time you actually have customer revenue. You can spend a lot of money and resources and time going down that down that curve before you end up on the other side of the J curve. But we finance that portion of it, and that's where you can get the most valuable returns if done right. Now, having said that, whereas Series C investors tend to have more of a private equity lens, probably have less of a loss ratio than we do. I mean, we expect on a best case scenario that 1 out of every 2 companies that we invest in will go to zero over a 3-year period. So we have a high loss ratio as it relates to our investments, but that's to be expected.
So JP, as you're looking through, I guess through the lens as a VC and all the different AI companies that are seemingly like flooding the pipeline, just curious, the lens you use as you're looking at some of those early stage companies, both in terms of where the market's heading, but also, around your thesis.
It's a great question. AI companies is an interesting statement. Every company needs to have AI, or it will lose to a company that does have AI. That's a fact. And it's not that the company needs to have AI to replace humans. It needs to augment the human workforce using capabilities that will enable someone to do more than they can do alone, or more than they can do with a team of humans. And there's a variety of reasons for that. But it's hard to invest in an AI company itself, even a foundational model, because a lot of these models are open source, and the differentiator is the data layer or the application layer that's built on top of the AI. So I think of it as, what's the AI inside? And when I talk to founders and entrepreneurs, if they're not thinking about things like classification, categorization, clustering, regression, dimensionality reduction, just at the highest level, what they're using in their systems from a machine learning perspective, then they're already behind a company. If they have a viable business and a viable market, they're already behind a company that is using those capabilities. So that's how we look at it. So I guess to answer your question, we don't really invest directly in an AI company. We invest in companies that do things with AI.
Yeah, so primarily on the application layer.
Yeah, well, some at the application layer, we have an investment in a company that uses AI to manage brand governance, for example. It's called BrandGuard. It ingests, brand marks and style guides and things, and then will tell you, out of an output vector of a generative model, of these 10,000 images, whatever it may, which are on brand, which are off brand, which are questionable, right? Examples are things like, an AI might create a picture of a runner drinking a soft drink as they cross a finish line, and the soft drink might be your soft drink that you want to promote, but the logo on the shirt might be something that comes from another brand that you might not want on. There's things like that.
Yeah, and I also went through. I think we lived in San Fran at the same time in like 98, 9. Went through that. I'm curious of just some of the, I guess, as people are shifting, like back then, everything was all commerce, essentially was moving online. So it's anything you sell, you can put online, create a startup around it, monetize it that way. Are there any parallels you're seeing from what's happening today to what was happening back then?
I think what happened back then to legacy incumbent businesses across every market is they realized very quickly that they needed to become software companies. They needed to have e-commerce as a channel, whether that's through a sales channel, a distribution channel, a communication channel, whatever it might be, but they needed to have a front end, let's call it a .com front end. And all of a sudden, companies that never realized they needed to be in the software business found themselves needing to be in the software business. I think with respect to AI, the same thing is is happening. Companies are realizing that these are capabilities that can do a whole host of different, there's a whole host of different value propositions that AI brings to the table. And you have to have a team that can, number one, understand where it's going to get the most yield. The juice is worth the squeeze, if you will. And at the same time, you have to have a team that can manage these things over time. Just like e-commerce, if you would have opened up a .com e-commerce store in the late 90s and never touched it, it would be very dated today. It wouldn't be dynamically responsive. You probably couldn't access it on an iPhone or any kind of smartphone, et cetera. So the same with AI models. Models have model drift. Models have augmentation. Models have ensemble conditions where you have multiple models doing an output, and you have to have a team that's in essence going to manage these things for the long-term benefit of the company.
That's great. And I guess if you put your VC hat back on, and as you're seeing a lot of the deals that are coming through, what are you seeing as potential risks or challenges with how people are, I guess, evaluating some of these companies, some of the startups that are coming into this space, and what might you be doing to mitigate any of those risks?
I think one of the biggest risks is that data science is not software engineering. And you may have a very smart, capable data scientist who has created some really good AI or machine learning models that have some potential. But if they don't have a software engineering team, it's going to be real hard to commercialize that model, and they have to find a way to bring those two things together. So we look at companies that have both strong software engineering capabilities and strong data science capabilities together, because that brings the value to bear for the enterprise, whether it's a B2B software sale or B2B2C or something direct to consumer. You can't just have a data scientist, if you will. The other thing that I think is important when evaluating a model is, the proprietary nature of either the foundational model, which usually they're open source anyway, or valuing the access and the data set that's actually informing that model. That's where the value lies, and then being able to create sort of a recurring flywheel of better data yields better results. Because if you have bad data, obviously you're going to go the wrong direction. So you have to have oversight on that as well.
Yeah, I mean, I know one of the we talked about this a little bit before, but just kind of the unique part about what we're doing with consumers, kind of sharing insights, ideas, just in a more human proprietary data type of way, as it being a data pipe into some of the reasoning that's happening. Just curious, as you're seeing different types of AI companies or AI startups who are either building at the application layer or more on the data model side, can you share a little bit just around like how unique that is?
I think what we talked about before, and I think the real unlock for an enterprise is to be able to use capabilities around AI agents to do a whole host of things, whether it's interviewing new employees on the front line before they come into your workforce, as a cursory scan of capabilities, whatever it might be, or whether it's managing employees who potentially have burnout and want someone the office of the I don't know if you know that term or not, but in consulting you kind of have this like neutral person you can go to and tell them anything, and they will help you with those challenges. You can AI a lot of these things, or at least have a conversational AI that can help somebody through a lot of these things. So you can use AI to manage workforces and workflows. You can use AI to develop, sentiment and market and trend analysis as it relates to customer and behavioral data. You can use AI for decisioning, for classification, for a whole host of things. So really, it's like setting up a factory. If you think of an AI factory in the enterprise, where dependent on the function of someone's role and what they're trying to achieve, they ought to be able to go into a team and say, this is what I need to do, or this is what I'm trying to accomplish with my functional role. What are some of the capabilities that we can automate and utilize, using machine learning models to make my job better, faster, cheaper, more powerful, right? That's the ultimate goal. It's like computer processing, right? If you have a very high horsepower, Apple M4 chip, it's going to work a lot better than some of the predecessors, right? It's the same thing with data synthesis, data analysis, whether it's in the FP&A function, financial planning analysis, whether it's in consumer insights, whether it's in human resources, whether it's in sales. AI is going to cut across all those things horizontally, but it's the packaging of the capabilities and then the augmentation of the human workforce where you get the real yield.
So JP, a few years back when we were collaborating, when I was at the Venture Founder with VF and you're at Baselayer, NFTs, so non-fungible tokens, were all the rage at that point. Can you talk about what happened from then until now and how kind of your thinking about investment has evolved kind of closer to the AI world versus the NFT world and kind of what happened there?
Yeah, I don't know my investment. First of all, investment theses always sort of migrate over time. They're not rigid by design. So you have to have an investment thesis that enables you to broaden the aperture as needed as technology advancements develop. As it relates to digital assets and NFTs, I think what's the interesting intersection there with AI is the ability to programmatically generate digital assets using generative AI models, attach those to physical goods, and have a system through which someone can own maybe one physical good and a whole array of digital goods under one, let's call it, receipt from a company, right? So you can do a lot of interesting things as it relates to NFTs. What happened, though, specifically in the let's call it the crypto bubble, is that there isn't a lot of utility around the NFTs, right? These things became objects of art, right? And someone's willing to pay a lot for something that they find beautiful, someone else might not be willing to pay that much for. So I think where you're going to see a real strong value proposition around non-fungible tokens specifically is where they do provide true utility. So, for example, if someone is utilizing a consumer product and wearing it a lot and earning a lot of NFTs, non-fungible tokens, coins, currency associated with it, can they trade that for something else? That bleeds into loyalty, and there's a bunch of companies that are pursuing around the loyalty aspects of non-fungible tokens. In fact, American Express recently invested in a company called SuperLogic, where I know the founders of, and they're building a bridge between the American Express reward system and digital badges that you can earn and trade and give away. And there's financial reasons for that because of the liability associated with traditional loyalty and rewards programs on your company's balance sheet are liabilities, and sometimes these non-fungible tokens can be zero cost to the company. The other issue, however, is that in order to be able to issue NFTs as a company and to be able to transact those and put them in a wallet, you actually have to have a money transfer license. So there is some issues related to how a company can create these things, and you can't just use AI and create an array of NFTs and put them out there anymore. There's a lot of regulatory stuff that's happening to try to control this. But at the end of the day, distributed ledger technology, being able to have capabilities of having assets that are portable, that live in the ether, that can be sent to the ends of the earth and then brought back very, very easily and simply, is a huge shift in how people will be able to have digital ownership over time. And its question will be whether that happens across multiple protocols or whether that happens on one standard protocol. The issue with respect to NFTs that's solved by NFTs is trust. When someone has an NFT or a Bitcoin or another distributed ledger element, you can't fake it because you can't receive it into a wallet, unlike counterfeit currency, for example, which can be faked. So So there are a lot of benefits to having that. And then again, the intersection between that and AI to me is around the generative component of it.
Can you talk about how, a brand, one of the brands that you and I both love, we'll say like North Face, for example, how could they apply this? Could they are a company that creates physical goods and that they also have the possibility of creating digital goods. Like, how could this come to life in the real world?
Yeah, a couple of ways it could manifest itself. One, if you think about the provenance as it relates to a piece of outdoor equipment or outerwear, would you want to have a history associated with your climbing gear, right? And easily a history that you could recall, a history that would never go away, and you could prove to someone that this jacket's been on Mount Everest or et cetera, whatever, if you're a climber. That's one way to do it, or one interesting thing from an end user perspective. Another thing to think about is as people utilize outdoor gear and equipment, the more they use it, the more they could earn into let's call it the where to earn capabilities. So how do you reward someone for time spent using something? Typically, companies have spending rewards programs. So if I spend $500, I might get 50 points, for example. Now, what if I spend 500 hours in the apparel? How do I reward someone for that? Or how do I have them prove that? So you can think about different use cases like that. And then over time, as companies think about influencer networks and ambassadors and other things, today, those are primarily marketing dollars spent to acquire, an ambassador or an influencer. Can you turn that around and reward them in your own currency and give someone the incentive to hey, here's some things to distribute on our behalf that are non-fungible, that you can trade, that you can give away to help, sort of drive influence and brand, brand ambassadors.
So JP, just to kind of dig through that a little bit more, I guess every conversation I've had with you definitely have not only an understanding of the consumer world, but also the technology of how it can innovate. And I'm curious if you were a CMO inside of any of these companies who's really trying to figure out, where do I put my marketing dollars? Because typically in a company it's where most of the funding goes towards. But it sounds like the consumer experience could be completely rethought or elevated. Just curious how, if you put that lens on, what would you do that might be, a little bit different than maybe the way that CMOs are operating today?
Yeah, I've never been a CMO, and a lot of the times, I'm going to probably say something here a little controversial. A lot of the times, I don't believe what CMOs say because when you ask a CMO how much of their marketing spend actually has real world attribution to it, that usually is about 50%. And so in the case where, in fact, you have a company like the F Corp, which spends, $850 million globally. That's almost $1 billion globally in marketing expense. What percentage of that has no attribution? What percentage of that? And it's a lot. It's a very high percentage. So I think if CMOs actually, I think the modern CMO is more of a data scientist. Actually, it's a different type of approach to thinking about how to put things out there that actually have a return on investment that is quantifiable and measurable versus putting it out there for what I would call, brand uplift, which has no quantifiable measures. You're seeing in my Yahoo days, we had, the beginning of programmatic advertising and ad trading and arbitrage as it relates to all that. There's even in those networks where you have, clear attribution in a publisher network as to where the ad placement was run. And if you look at the cookie space, you can kind of say that you bought this segment and you're willing to pay for it because it's your segment. You still have fraud. You still have traffic quality fraud in those networks that is 10 to 15 to sometimes 25% of the total traffic that flows through your network. So you can't get away from kind of like spending money. Every dollar spent, somewhere between 50 50 cents to 25 cents of it is lost. But I think you can change that. You can start to bring that back in if you start to think about PR from not necessarily from a publicity perspective, but think of it more from a profit center standpoint. So if I'm going to do something in the modern era of marketing, can I do something where I'm rewarding my consumers for promoting my brand and actually giving them value versus paying an ad network to capture that audience? The agencies stand in the way of a lot of this because agency relationships and agencies of record, every large company has one, and they all work well to not lose your audience, right? They help to grow your brand. They help to, so they do a good job, but they're not technology providers. They're not revenue generators per se. They are marketing organizations that provide you, the leads or the brand placements that then subsequently, if you have a good product and you have a good process, turns into revenue, right?
Yeah.
So to me, I just think that the whole marketing dynamic eventually will change. And I think you're seeing that, especially with generative AI today. You're seeing a lot of these agencies having to, again, become software companies because they have to manage this, or a company is just going to realize that why would I pay for this when I can do it, internally.
That's great. I think we're going to do a little bit of a pivot again onto more to like B2B, on the B2B side of just kind of tech software or SaaS startups, things like that. I guess, is SaaS dead?
Chad, can you explain what SaaS is for our listeners?
Yeah, software as a service, of just the idea of billing on recurring, might be like monthly reoccurring revenue models at a kind of a per user price.
Yeah, I don't think so. I think, and we invest in a lot of B2B SaaS companies, so sure hope not. But I think that there's a different, there's consumption-based pricing, there's value-based pricing. There's all different ways to price, software and technology capabilities in the enterprise. I think it's a matter of what the pricing model is that fits your customer. And so maybe, the software as a service, classic, what X number of dollars per month or per year might change over time. But I think it's incumbent on, any B2B company to determine what's the best pricing model for their customer, and in conjunction with the customer, develop something that's a win-win for both sides. Because if you're truly selling, key capabilities that an organization needs, then that company should be willing to pay for it if it's helping them achieve, one of their business objectives.
Yeah, I was just kind of taken aback by just some of the Salesforce earnings, that came out, and also having sat through some of the actual, demos of how their AI like feature set essentially works within their products. And just how companies that I would say are just more traditional SaaS oriented, just how they're approaching the space. Even to some of the like Slack announcement where they've kind of hidden their opt-out policy of training all their models.
Slack's a great example of a tool that has existed for a long time, and it just finally found its way into the enterprise through, product-led growth, right? People needed a way to communicate in this manner, to store files associated with the thread of communication, to be able to invite people, to be able to spin up channels. AOL Instant Messenger, had some of these capabilities way back in the day as well, and lots of enterprises used AOL. What ends up happening a lot of the times is the IT organization of a large Fortune 500 company actually stands in the way of innovation. They will, because of policy and cybersecurity risk and all other things that they are keen to protect themselves from or adhere to in the case of privacy and other kind of global regulations. They have to have such rigid acceptance criteria to bring in a vendor that sometimes a fast-moving startup can utilize the capabilities from some of these technologies much more easily and capture more value than a large company. And so I feel like the best companies operate as mini startups, right? They allow their people to use technologies that they need, provided that these technologies are not open source or that they are commercial grade technologies, and they don't make it really hard to buy and try stuff. And the companies that don't do that suffer from two problems. They suffer from not being able to leverage the technologies to bring to bear for their business objectives, but then they also hamstring their own employees, right? If you standardize on the Microsoft platform and everyone's on Microsoft Teams and the Microsoft productivity suite and everything, the minute that you leave that company and go do something else, you have to retrain. And that becomes a challenge from a skill set perspective.
So JP, when you think about kind of the development and deployment of these AI systems, what are some of the risks? And also, can you talk a little bit about like how we should regulate some of these systems?
Well, on the risk side, I don't know if you looked recently at the kind of some of the ridiculous Google Gemini answers, right? Like one of them is like, should you drink gasoline? And you're like,
glue
only
pizza.
Right. only after dinner, right, or something like that. Like these are ridiculous things that for someone who is utilizing this technology, clearly would be able to see that, but a naive person or someone who has a language barrier might not understand that. So there needs to be some, let's call it, governance around the output vectors of these models for the particular use cases, and that's incumbent on whoever's providing that model for whatever customer they have, whether that's a consumer or whether that's a business customer. However, when it comes to government-based regulation, I do not believe that is a wise path forward for the very reason that if we try to dampen the advancement of these capabilities, our competitors around the world will beat us in these areas. And so we need to push the regulation to the commercial user or the commercial platform that's commercializing that, not try to mandate it from a governance standpoint.
So you're saying that like a company like Vurvey should be part of that like regulation?
Yeah, a company like yours, you ought to stand behind the output vectors of your models, the quality, and that's your value proposition to your customer, right? As opposed to having a third party come in and sort of do that. Cybersecurity has standards, that are largely policy-based standards usually. But at the end of the day, when you go assemble a cybersecurity technology stack in the enterprise, you have a CISO that does that, and that person is held accountable. So the same thing has to happen in large enterprise. You can't just, if you buy a Ferrari and you drive it really fast on a 15-mile speed limit road and crash it, whose fault is that? It's your fault, right? So these capabilities can be like sports cars, but it's not incumbent on the sports car manufacturer to put a throttle on that. It's incumbent on whoever sold that to you to make sure that you understand what you've bought and how to use it.
Mm-hmm. So that was regulation, but curious about like also algorithmic bias. Like, what do you have any examples of like companies that are doing a good job, or things that we should be looking out for when it comes to that?
Yeah, there is algorithmic bias. I don't know that anyone has really cracked on the way on how to do that the best way, but models do have model drift. You have to have oversight in the model itself over time to make sure that its output vector is as expected. You should never, purely just trust a black box model. That there's risk in that. It's more, I guess, it's more on the education side, Sarah, where it should be incumbent on companies that are promoting AI to help educate their customer on the capabilities and how to use it and the potential pitfalls and drawbacks. Again, that goes back to what I said before. It's rarely a case where there's going to be AI replaces a human function. It's more like AI changes the operational architecture of how a functional role is done and enables someone to going forward due the power of, what would have been for, multiple people or 10 people or 1,000 people, whatever it might be, how much yield you can get. But those things it's educational in the sense that, you can't just go out wielding these very powerful tools and expect everything to just, work, perfectly. It's never the case. It's much like software engineering, right? If you write, Chad would know, if you write a technical specification and you ship it off to an offshore developer and you come back, 3 to 6 months later looking for the alpha or beta version of it, and you didn't interact with them once, good luck.
Just out of curiosity, are there any companies out there that are doing a good job, in your mind, educating consumers around bias and other things?
Not that come to mind. I mean, there are companies that I'm sure every consulting firm in the world has an AI, sort of thought leadership practice right now, and an area where they can do that. But I don't know any that are doing it purely from an educational or ed tech perspective. But certainly, there's probably an opportunity there to from a train. People are going to need to reskill in order to utilize these tools. So there's probably great opportunities around developing, AI training and skills in the same way code boot camps existed and have existed for the last 10 years.
All right. Well, we have a bit of time left, and we want to show you something that we created. So we created a VC agent, and I'm going to pull it up, and I'm wondering if you have a question or two for this agent, and we're just really curious about how, on this agent is, or if it's totally off. So I'm going to pull it up, and I'm going to share my screen.
So first, JP, are you using agents at all?
Not in our venture fund. I mean, in portfolio companies, certainly, but at the fund level, a lot of the stuff that we do at the fund level is really transactional, and I could probably use an agent to help with some of the workflow, but really, it's we're not using any right now.
All right, can we see my screen?
Yeah.
Okay, so you're in Vurvey right now. This is created a venture capitalist agent. I'm going to go back so we can actually see the agent here. I tried to, not that I tried to make him just like you, but I tried to as best I could create a venture capitalist agent. So with an expert on tech and investment, we give them background and also instructions on how to answer. So let's go here. What type of a question would you like to ask this venture capital agent?
What are some of the pitfalls in using a safe note versus a convertible note as an investment in a startup?
As a venture capitalist with expertise in software engineering, let's see. Can you guys see my screen?
Excellent. It's actually very, so that was going to see if it would come up with that first. The key here is that lack of maturity date. Most safes don't have expiration dates. And they're very founder friendly because a founder can take money on a safe or a series of safes, and if those things never have expiration or maturity dates, they never really have to convert them to a certain extent. There's some risks there. So that is a very it's exactly what I would have said and exactly what I expected. So yeah, this is a nice output.
Pretty decent. And just for our listeners, can you just explain the difference between a safe note and convertible note?
Yeah, a convertible note is an actual debt instrument that is putting debt on the company and has certain provisions associated with it. A safe, which was pioneered by Y Combinator, is exactly what it stands for: a simple agreement for future equity. And so you're basically going into a very simple agreement with the company that if they're going to raise an equity round later, that you will get a portion of that with certain terms. So one is a true debt instrument. The other one's more of a kind of a piece of paper.
Okay. Any other question?
What are the revenue ranges and valuation ranges for a Series A company?
Let's see.
Yeah, nice.
Yeah, and valuation ranges.
Yeah, I would have. That's what I expected.
That was fun. So the way that I created that was I just started talking to the agent. I started talking to Vurvey, asking like, what kind of background should I create for this agent, and I put that in. What kind of instruction should I give this company based on the background? And it created this for me. But I also had like making sure it was around tech and making sure it was around kind of like I had business acumen and certain things around technology, but it was all created within Vurvey last night in about 10 minutes, which is kind of cool. All right, I guess just like one last question too. When you think about businesses to watch in the AI space, do you have any examples of businesses that you're excited about?
I recently met a team from San Francisco that moved here to Miami that actually has created a new so let me take a step back. A lot of the generative AI models are heavy computational load frameworks, meaning you need a lot of GPU to process, especially on visual output vectors. They've created a new architecture for a foundational model that requires zero GPU. And they're trying to actually commercialize that and bring it to market. So that's just a team of 2 engineers from San Fran, and they I'm actually meeting with them this week. The question around their capabilities and that even particularly that model is that if that's a unique approach that they stumbled on doing R&D at a larger company, which is how they got there. Are there other approaches that are also computationally light that could be, also developed? So that would be one of the questions. But solving for heavy GPU loads is one of the most interesting areas right now.
JP, any advice you'd share with just tech founders who are coming into this space right now and trying to win favor on, I guess, investing in their ideas?
I give all tech founders the same advice, is, be super passionate and with conviction about the problem you're solving, and then bring everything you can to bear technology-wise and resource-wise to solve that problem for your customer. And so, I think earlier in this conversation, we talked about like, what are the new approaches to AI or and that's not really it, right? It's more like, what's the problem we're trying to solve? Mm-hmm. Why does someone have such an acute pain, and why am I and my organization qualified to solve that? So you have to understand the market, or at least have conviction and passion around that market. You have to have a set of resources, human and technical resources that can solve that problem better than anybody else. And then you have to have a customer, especially if you're an early stage startup, that understands that, this software evolves over time. And if they're going to be an early design partner with you as a customer, or if they're going to be, one of the early alpha or beta customers that are using, some of your early technologies, that their input is super important, because you want to be able to build things that they're going to continue to utilize, and not just be a stopgap solution as they look for something else. So for founders to build something that a company becomes a core part of another company's business, such as Salesforce did, obviously, or as Amazon has done for sort of consumers, that's where you get a lot of enterprise value and ROI. And so that's what I tell founders is, go spend time with your customers, go solve their problems, use every single thing that you can to solve that problem in terms of high tech and strong capabilities, and that's it.
Thank you so much. This was awesome.
Okay. Yeah, thanks, JP.
Well, that was a cool interview with JP. I always enjoy chatting with him, and it's cool too, because we haven't had a VC on before to talk about investment and talking about kind of the landscape of AI startups.
Yeah, I mean, it's moving super, super fast, and I know JP is plugged into all of it. And that's
a million miles a minute with that one.
Yeah. I mean, that's why I love the conversation with him. Is that it's not it's something he's very invested in, both literally and figuratively. But you have to be obsessed with this space and be really excited by it. And I know, just through the many conversations I've had with him, this is something he really believes in, and I think can help startups, founders move their ideas forward. So I could talk with JP for hours about this. So excited to have him on.
That was great. All right, well, that's going to do it for this episode of AI Powered by People. The show is produced by Steve Berkowitz and brought to you by Vurvey. Thanks for listening. We'll be back next Tuesday.